We are told everything is fine. They say the future is bright, electric, and abundant. This is a lie. History has a habit of laying the groundwork for disaster years in advance. The systemic logic never changes. Look back at 1970. The U.S. domestic silver supply was collapsing. Treasury coin melts spiked immediately. The structural mechanism for the end of a monetary era was already in motion. That systemic logic is back. It simply cycled into a more sophisticated disguise. The global financial system today is just as brittle as the gold-backed system was over 50 years ago. The pressure point this time is not gold. It is the metal that powers the green transition. It is industrial money, silver. The critical disconnect is already visible in the data. Mine output is stagnating globally. At the same time, industrial demand is accelerating at an unprecedented rate. This is the recurring mechanism of depletion and expansion. It always ends in a price shock. The current global silver market deficit is an economic malignancy. It demands attention. The supply squeeze is tightening right now. Forget minor price fluctuations. We are witnessing the final stages of a systemic shortage. This pattern should keep you awake at night. The story of the silver deficit is a story of systemic neglect. It is a logic built on treating a finite asset as an endless commodity. To understand the present danger, you must look at the past. It is a blueprint of failure. The fragility we see today began in the 19th century. Silver was money. Governments saw it as a tool to be manipulated, not a resource to be conserved. The Coinage Act of 1873 in the United States was the first great act of systemic demonetization. They called it the Crime of 73. This act officially ended the bimetallic standard. The U.S. effectively moved to a pure gold standard, sidelining silver. This was not a move for efficiency. It was a calculated decision to limit the money supply. It was a consolidation of power. The consequence was mathematical. It introduced the modern logic that silver was secondary. It was treated as merely an industrial byproduct. This decision removed silver's monetary floor. The metal would now be tossed around by industrial appetite alone. The pattern of its price volatility was encoded right there. Fast forward to the 1940s. The U.S. government began accumulating massive stockpiles of silver. They recognized its military and industrial necessity. By the end of World War II, the U.S. held the largest government silver hoard in history. This massive reserve was a buffer. It gave a false sense of security against the world's industrial expansion. The systemic flaw was still in place. Consumption was accelerating faster than discovery and extraction. The 1950s saw the beginning of the end for that reserve. Industrial demand for photography, electronics, and brazing alloys began to chew through the stockpile. In 1959, the United States finally began to run a net silver deficit. This was the first seismic warning in modern history. Consumption permanently exceeded domestic mine production and scrap recovery. This systemic stress was immediately ignored by policymakers. The final monetary collapse of silver began in the 1960s. The U.S. Treasury was unable to cope with the demand. They stopped selling silver to the public in 1961. This action confirmed the structural weakness. The government was admitting the well was running dry. People understood the consequence immediately. They started hoarding silver coins. They melted them for their metal content. The free market was rejecting the government-assigned value. The melt value exceeded the face value. This is how public confidence breaks. The ultimate admission of failure came on June 24, 1968. That is the date the U.S. Treasury ended the redemption of silver certificates for silver bullion. This moment was the final and complete demonetization of silver in the U.S. currency system. The pattern was complete. Silver was officially kicked out of the money game. The price remained artificially depressed for years. This reflected the market's belief that government stockpiles would always be available to suppress the price. Then came the Hunt brothers in the late 1970s. Their attempt to corner the market was a direct result of that engineered systemic weakness. They recognized the inherent undervaluation of the metal. It was essential to industry but priced like scrap. Their buying spree drove silver from under $6 per ounce in 1979 to a high near $50 per ounce in January 1980. This is a shocking number. This spike was not a simple speculator's folly. It was a violent, temporary correction. It proved the inherent volatility and the potential for explosive price moves when the supply side is fragile. The result was a financial panic. They called it Silver Thursday. Governments and financial institutions learned the wrong lesson from 1980. They did not learn to conserve the finite resource. They learned how to suppress its price more effectively. They learned how to create paper derivatives to mask the physical deficit. The decades that followed were characterized by continuous, massive structural deficits. These were financed by selling off old government and private hoards. The metal was not being mined. It was being liquidated from inherited wealth. This is the definition of a finite asset being hollowed out. By the 1990s and 2000s, this systemic logic had fully matured. Mine output was increasingly becoming a byproduct. Approximately 70 to 80% of global silver production today comes as a secondary metal. It comes from mining gold, copper, lead, and zinc. This is a critical factor. The price of silver does not dictate its supply. The economics of base metals dictates silver's availability. If copper miners shut down because copper prices fall, silver production shuts down regardless of the silver price. This structural dependency is a deep systemic weakness. Throughout the 2000s, the increasing demand for solar panels and advanced electronics cemented silver's role. It is an indispensable industrial metal. It is not an alternative. It is an absolute necessity. Yet the price continued to trade like a commodity with endless supply. It was always vulnerable to the massive paper short selling in the futures market. This is the subtle, light conspiracy at play. Keeping the price low for a strategically critical industrial metal is a national economic security goal. The recurring mechanism is clear. The systemic logic moves from demonetization to reliance on stockpiles. It moves from stockpiles to continuous annual deficits. Finally, it moves from deficits to a price spike when the paper mask rips off the physical reality. Every single time. It is the consequence of treating a physical asset as a purely political one. The history of silver is a history of exhaustion disguised by financial engineering. We are now living in the inevitable conclusion of this systemic logic. The financial engineering of the last 50 years has reached its terminal point. The hoards are gone. The physical exhaustion is undeniable. Look at the latest data. The Silver Institute reports that the global silver market recorded a staggering deficit in 2022. This deficit was over 237.7 million ounces. This is the largest recorded annual deficit in history. That is not a fluctuation. That is a systemic failure of supply to meet demand. The pattern has accelerated. This monumental gap was not closed by new mine supply. It was filled by depleting above-ground inventories. The situation is only worsening. Preliminary data for 2023 indicates the deficit remains massively elevated. It is on track to be one of the largest on record again. Meanwhile, global mine production is stalled. We are not finding massive new deposits. The total global mine output is stuck. It hovers below 900 million ounces for several years now. This is a critical breaking point. The low-hanging fruit has been picked. Finding and developing a new silver mine is a decade-long, multi-billion-dollar endeavor. The risk-reward ratio is too skewed when the price is suppressed. The green transition is the accelerant to this systemic instability. Silver is irreplaceable in photovoltaic cells. It is the most conductive material on Earth. The solar sector's consumption of silver has exploded. The solar industry alone is consuming over 140 million ounces annually. That figure is expected to continue its vertical ascent. This is industrial demand that cannot be turned off. There is no simple, cheap substitute. This is not optional demand. This is structural, mandated demand. The inventories held by the major futures exchanges are showing the stress. They are at multi-decade lows. The COMEX registered silver inventory, the metal actually available for delivery, has dropped dramatically. This registered inventory level is a clear warning sign. When the paper contracts are backed by less and less physical metal, the fragility increases exponentially. The market operates on the premise that only a small percentage of contract holders will ever demand physical delivery. That premise is an illusion of liquidity. The massive paper market, through leveraged short positions, has successfully kept the price below its true cost of scarcity for years. This is the sophisticated, modern core of the systemic extraction. It is a subtle transfer of wealth. It moves from miners and long-term holders to the industrial consumers. They benefit from cheap inputs. They are mining the paper market. They do this to keep the physical price low. This mechanism is a direct continuation of the crime of 73. It is the financial extraction of a physical asset. The current price volatility is not random. It is the sound of the paper market starting to buckle. It buckles under the weight of the physical truth. The deficit is mathematical. The current price is political. The gap between these two facts is where the final, unavoidable crisis will emerge. The system is consuming its seed corn. This should be a source of deep, urgent fear. The conclusion is inescapable. This systematic deficit cannot continue. It will result in a violent, parabolic price revaluation. History is merely the rehearsal for this final act. The $80 dream is not a speculative fantasy. It is the minimum mathematical correction required. It is required to rebalance the supply-demand equation. When the final pattern completes, the price will not rise smoothly. It will spike instantly. There will be a moment when the industrial consumers realize the registered inventory is exhausted. The paper short sellers will realize they cannot cover their obligations. The metal simply does not exist. This realization will trigger a scramble for physical supply. The consequences will be brutal and sudden. Industrial users will be forced to compete directly with investors. They will compete for a shrinking pool of physical metal. This competition will lead to the rationing of silver. Solar panel manufacturers will face a material constraint. No amount of government subsidy can fix it. The green transition, currently hyped as the solution, will become the primary victim. It is the victim of the systemic neglect of its most critical input. This is a disaster coded into the current economic architecture. The ripple effect will be felt across the entire electronic supply chain. Everything from medical devices to smartphones requires silver. A prolonged shortage means systemic stress in the production of every modern necessity. You will see production lines stall. You will witness the failure of just-in-time inventory systems globally. The fragility of our hyper-efficient, paper-based economy will be brutally exposed. It will be exposed by the simplest of physical realities. The coming shock will expose the derivative market's utter lack of physical backing. The confidence game will shatter instantly. This is not about a minor commodity correction. It is the collapse of a deeply fraudulent pricing mechanism. It is the final price for decades of treating a strategic metal as an exhaustible monetary punching bag. This is the inevitable consequence when the systemic logic of perpetual extraction meets the finite constraints of geology. The physical reality always wins. This is the final warning. This video explains historical and economic systems. It is informational, not financial advice or price forecasting. We have mapped the repeating mechanism of systemic failure. We have quantified the largest recorded deficit in history. The physical supply is running on fumes while demand accelerates. The paper market is a thin membrane stretched over a widening void. When that membrane breaks, the velocity of the price move will shock everyone. The time to understand this structural risk is now. Do not wait for the inevitable headlines. The logic of the collapse is already written in the numbers. The promise is political. The consequence is mathematical. No one escapes. Hit subscribe and join the community that tracks the patterns of systemic collapse. Share this video to wake up someone you know. Do not let the history of failure surprise you again.